Hey everybody, thank you so much for checking the channel out today. My name is Agabus. This is your financial education channel, and I had to share this crazy news article from the other day and just get your thoughts on what you think it might mean for the economy. Today we're over at Markets Insider. The S&P 500 will rocket 18% by year end as the economy stays strong and the Fed ends interest rate hikes, according to Oppenheimer investment chief. The S&P 500 is due for a monster rally by the end of the year as the Federal Reserve looks poised to dial back its war on inflation, according to Oppenheimer's chief investment strategist, John. In an interview with CNBC on Thursday, he reiterated his S&P price target prediction of 4,900 by the end of the year. Just for context, if the S&P 500 did hit 4,900 by the end of the year, not only would it be up 18% in the next 2 months, but it would also then hit all-time highs. I'm a little skeptical. John said, you've got to remember that when we raised that target, we were expecting that the Fed would continue to be vigilant against inflation, but would remain sensitive to the effects of its policy on the economy, and it has remained so. As we all know, central banks have hiked rates aggressively since March of 2022 to tame inflation, with the Fed's rate now at 5.25% to 5.5%. This week they're meeting again to see if they will increase another 0.25%, but it looks like the market is pricing in that they will stay flat for the rest of this week. Corporate earnings also look to have held up despite some disappointing results this week from the largest tech firms. Of the 17% of the S&P 500 companies that reported third quarter earnings last week, 73% have beaten analyst estimates, according to fact check data. And those stocks have sold off in recent weeks. That's largely due to fears stemming from higher treasury yields, with the 10-year topping out at 5% for the first time since '07. The Fed has warned that rates could stay higher for longer as it continues to monitor inflation and the strength of the economy. Still, markets are expected interest rate cuts by mid-next year, with investors pricing in an 80% chance that rates could be lower than their current level by the summer of next year. Only time will tell, but would love to know what you think interest rates will be at July of next year. To piggyback off of that, we're over here at CNBC, where stocks bounce today, Monday the 30th, as S&P 500 tries to climb out of correction territory. So far for the day, or early in the day, the U.S. stocks rose Monday as traders braced for a big week with the Federal Reserve decision. The rally was broad-based, with 11 of the S&P 500 sectors trading higher. Communications, consumer discretion, information technologies are all outperforming, and mega cap tech stocks also rose as well. The moves after the S&P 500 fell into correction territory last week, the broader index shed 2.5% for the week to put it down more than 10% from its 2023 high. It's off 3.2% for October, on pace for its third straight negative month, which would be the first such streak since 2020 when the pandemic struck. The Federal Reserve decision will loom on Wednesday, when the central bank is widely expected to hold its benchmark interest rates at the same level. With interest rates as their main culprit for the market correction, investors are hoping the Fed could signal that they're done raising rates. Again, tell me what your thoughts are. Thank you so much for checking in today. Make sure to stay informed, stay inquisitive, and stay subscribed for more. We'll see you tomorrow.